In April 2026, Meta reported a quarter for the record books. Net income up. Advertising revenue up 33%. Earnings per share beating Wall Street's estimate by more than half. And in that same quarter, Meta spent $0 buying back its own stock, the first time it had done that in years, while it locked itself into $107 billion of new multi-year commitments it cannot walk away from. 3 weeks later, the company laid off roughly 8,000 people. About 1 in 10 of everyone who worked there. Here is the part that should sound strange and mostly doesn't anymore. This wasn't a company in trouble cutting costs to survive. It was a company with more money than it knew what to do with, choosing, deliberately, on the record in the same earnings call, to spend that money on machines instead of people. That choice is happening at a scale and a speed that doesn't have a name yet. This episode gives it one. Here is what corporate capital expenditure, CapEx for short, technically, mechanically is. Money a company spends building or buying long-term assets, factories, servers, data centers, that it expects to pay off over years, not quarters. Here is what it is not, at least historically, a fixed obligation. A CapEx budget is, in ordinary times, the most flexible line on a company's books. Demand softens, you slow the build-out. Financing tightens, you defer a data center by a year. In ordinary times, CapEx is the thing companies adjust to absorb a shock, not the thing that causes one. 2026 broke that assumption, and the break is the actual subject of this episode. The 4 companies driving this, Amazon, Microsoft, Alphabet, and Meta, have committed a combined $700 billion to capital expenditure this year, roughly double what they spent in 2025. Footnote 1. That is not $700 billion of ordinary factory building. A large and growing share of it is locked in through multi-year, non-cancelable purchase commitments. Chips, data center capacity, power contracts, signed years in advance because the chip suppliers and power utilities on the other end of those deals need years of lead time themselves. Once signed, that obligation behaves less like a discretionary budget line and more like a mortgage. It cannot be trimmed if the AI revenue it's betting on doesn't show up on schedule. That distinction, discretionary capex versus locked-in obligation, is the mechanism this episode is actually about. It is also, not coincidentally, the same pool of money that used to flow somewhere else. For the better part of a decade, this series and its companion have documented where record corporate profits typically go. Back to shareholders via buybacks, in numbers that reached $1 trillion across the S&P 500 in 2025 alone. Footnote 2. That was the established pattern. Profits up, buybacks up, headcount roughly stable or growing. 2026 is not running that pattern. Meta didn't redirect its buyback money to shareholders and also cut costs elsewhere. It eliminated the buyback and cut headcount, funneling both pools of capital into the same AI infrastructure bet. Alphabet went further still. It didn't just pause its buyback program, it suspended it entirely and took on tens of billions in new long-term debt, turning cash flow negative in a quarter where net income still rose sharply. Footnote 3. Companies that spent the last decade being lectured, by this very series, for prioritizing shareholder returns over their own workforce are now doing something stranger. Deprioritizing shareholders too in favor of compute. Nobody had to conspire to produce this. No memo went out coordinating it across 4 competing companies. What happened is simpler and, honestly, more unsettling, for companies facing the same competitive pressure, falling behind in an AI infrastructure race none of them can afford to lose, independently made the same calculation about where their money had to go, and workers and shareholders both landed lower on that list than they used to. Here is the contrasting pair this episode is built around, and it isn't the usual 2 numbers, same quarter shape this series normally uses. It's 2 capital decisions, same company, same earnings report, pointing in opposite directions from where they used to point. Meta Q1 2026, GAAP diluted EPS of $10.44, more than 50% above what Wall Street expected. Footnote 4. Buybacks, 0, down from $12.75 billion the same quarter a year earlier. Footnote 5. New multi-year infrastructure commitments added to the balance sheet, $107 billion. Footnote 6. Layoffs announced weeks later, approximately 8,000 roles, about 10% of the company. Footnote 7. CEO Mark Zuckerberg told staff that success isn't a given in the AI era. 5 words that, 3 weeks earlier, would have accompanied a buyback announcement instead of a headcount reduction. Footnote 8. Alphabet, Q2 2026. Revenue up 22% year-over-year. Net income up 81% in the prior quarter alone. Footnote 9. And in the same stretch, buyback programs suspended, roughly $70 billion raised through new equity and debt, long-term debt doubled to over $98 billion, and free cash flow turned negative for the first time in the company's history as a mature, profit-printing business. Footnote 10. Those two companies alone make the case. But the pattern isn't confined to them. Oracle confirmed in a June 2026 regulatory filing that its global workforce fell by roughly 21,000 people, about 13%, over the prior 12 months, explicitly tied to AI adoption. In the same period, the company reported its best growth quarter in 15 years and continued raising and borrowing billions for AI data centers. Footnote 11. Times reporting, based on interviews with 8 former employees, described a specific and uncomfortable sequence at Oracle. Workers were asked to document their own workflows in detail, ostensibly to improve internal tools, shortly before the roles built around those same workflows were eliminated. Footnote 12. One laid-off employee, a technical writer with 19 years at the company, described training the system that replaced her. The human-scale version of this. Across the 4 largest AI infrastructure builders, roughly 142,000 tech workers lost their jobs in 2026 through late May alone, while those same 4 companies were, in the same months, committing more capital to AI infrastructure than the last full year combined. Footnote 13. Put another way, for every roughly $5 million of new AI infrastructure commitment made this year by the hyperscalers, 1 job somewhere in the sector disappeared. This is not the buyback story this series has told before. It's a related mechanism wearing a different mask. Money still moving away from workers, just no longer stopping at shareholders on its way somewhere else. Start with the apparent fixes because there are a few and each one sounds reasonable until you look at it straight on. Regulators could require enhanced severance or extended benefits tied to a company's profitability at the time of the layoff. The same logic already exists in a handful of state and municipal ordinances, none of it federal, none of it mandatory where it would apply here. Congress could tie tax treatment of AI capital expenditure to workforce protection commitments, the way some infrastructure tax credits already require prevailing wages. Shareholders could vote down infrastructure spending plans that eliminate headcount without a demonstrated return. The same say-on-pay mechanism this channel's companion series has already shown you gets a yes, 9 times out of 10 anyway. None of it happens, and not because anyone's hiding the ball. It doesn't happen because none of these companies are choosing to gamble. They're choosing not to lose. Here is the logic stated plainly because it is not actually irrational. AI infrastructure at this scale takes years to build and, once built, is extraordinarily difficult for a competitor to catch up to. If the bet pays off, the company that built first owns the category for a decade. If the bet doesn't pay off, every company that built anyway loses roughly the same amount. But the company that hesitated loses more because it's now trying to catch up from behind, against competitors who already have the infrastructure in place. In a race with that shape, going all in isn't reckless. It's the only individually rational move available. Sitting it out is the actual gamble. The workers caught in this are not part of the calculation at all. Not in a callous, deliberate sense, in a structural one. The infrastructure bet resolves on a timeline of years. The payroll savings from a layoff resolve immediately, this quarter, on the same earnings call where the CapEx commitment gets announced. Nothing forces those 2 timelines to line up. A company doesn't need to know whether the bet worked before cutting the people whose salaries help fund it. By the time anyone can tell whether the AI infrastructure paid off, the layoffs are already 3 or 4 earnings cycles in the past, absorbed, forgotten by everyone except the people who lived through them. That's the locked room, and it doesn't look like the ones this series has named before. There's no villain holding the key, no single actor who could open the door if they just wanted to badly enough. There's no lawsuit to file, no vote to win, no rule to repeal. 4 companies, acting independently, rationally, and legally, arrived at the same structural outcome, not because they colluded but because the competitive math left exactly one sane answer, and workers weren't a variable in the equation at all. Every door has a locked room behind it. This one doesn't have anyone standing guard. It doesn't need to. Nobody's trying to get out because nobody in the room made a mistake. Here's what makes those $700 billion in non-cancelable commitments genuinely fragile, in a way this episode hasn't touched yet. They aren't commitments to abstract AI infrastructure. They're commitments to specific physical components, made under the assumption that the companies selling those components can actually deliver them, and that assumption is already cracking. Take memory chips. The high-bandwidth memory that AI accelerators depend on is produced by exactly 3 companies worldwide: Samsung, SK Hynix, and Micron, who between them control more than 95% of global drum production. Footnote 14. All 3 have spent 2026 reallocating factory capacity away from the ordinary memory chips that go into laptops and phones, toward the AI-grade memory hyperscalers are locking up years in advance through exactly the kind of long-term supply contracts this episode has already described. The result? Everyday memory prices have risen 80 to 90% in a single year, and in July 2026, SK Hynix's own CEO said publicly that the shortage will likely persist past 2030. Footnote 15. 3 companies, none of them American, now sit in the critical path of every AI infrastructure bet described in this episode, and none of the 4 hyperscalers building that infrastructure can do a thing about it beyond paying whatever those 3 companies ask. That's the visible choke point. It isn't the only one, and it isn't even the most concentrated one. Underneath the memory shortage sits a longer supply chain most people have never had a reason to think about: the rare earth processing, chip packaging, and testing capacity that turns raw semiconductor output into something a data center can actually use, much of it running through countries small enough that they rarely make a headline of their own. A production hiccup, an export restriction, or a single plant closure in one of these places doesn't just dent a quarterly earnings report. It can freeze a $700 billion infrastructure bet exactly where it's most exposed, after the money's already been spent, before the payoff has arrived. Follow the money far enough, in other words, and it stops running through Meta's balance sheet or Oracle's layoff notices entirely. It runs through a handful of countries that, until now, most of this audience couldn't have named, and whose leverage over the outcome of this entire AI infrastructure bet may turn out to be larger than any single hyperscaler's. Which raises the obvious next question. If a handful of unglamorous, easy-to-overlook countries can quietly decide whether trillion-dollar infrastructure bets succeed or fail, who are they exactly, and what happens if they decide not to cooperate? Not every layoff in 2026 fits this mechanism, and it's worth saying so plainly. Automotive is cutting jobs too. GM idled a Detroit plant and paused battery cell production. Ford and Stellantis have absorbed billions in tariff costs, and suppliers across the industry are bracing for what analysts are calling a coming wave of bankruptcies. Footnote 16. But that's a different story wearing similar headlines: softening demand, tariff exposure, and a bumpy EV transition, not profitable companies redirecting capital toward a speculative infrastructure bet. Automakers aren't gambling on a payoff years out. They're managing a downturn that's already arrived. Worth knowing the difference, because conflating the two would blur the exact mechanism this episode spent 4 sections building. Here's the whole argument in one sentence. The money didn't disappear, and it didn't even really get hoarded. It moved all at once into a bet none of these companies can afford to lose, and none of them can afford to be wrong about too early. That's not manipulation. Nobody needed to lie, hide anything, or coordinate across 4 competing boardrooms to produce this outcome. It's simpler and, in its own way, more unsettling. Rational people doing the rational thing, arriving at an outcome nobody specifically chose and nobody can specifically be blamed for, while the workers caught in the gap between the bet being placed and the bet paying off absorbed the cost first, on a timeline nobody promised them would ever get squared up. The infrastructure this money is building doesn't exist in a vacuum either. It depends on chips, packaging, and materials controlled by a handful of countries most viewers couldn't point to on a map. And that's exactly where this series goes next.